everybody. This is Fred Meissner with the weekly Fred Report conference call for February 10th, 2011. We've got a couple of people on the call, Jeff on the call, for example, with some schedules, so we're going to get right into it, and we're going to be a little bit quicker with the initial parts of the call and then be open, obviously, for questions. So we're going to get right into it. First of all, the stock market. Looking at the market here, we're in one of those phases where the SPY is overbought, and the condition indicators are saying there's some issues, i.e. sentiment is overbought as well, the transports are lagging and such. This is obviously one of the hardest types of markets to play, but I think the key thing to remember here is the moving averages are up, and that means the trends are basically up on the S&P 500 until that changes. My guess is since the stochastics are now a bit overbought, we're going to see a little bit of choppiness coming into expiration week. But remember, guys, this overall environment is bullish, and so we may correct a little bit, but we would use that as a buying opportunity if we were going to in other words, if we're holding cash, we're hoping for a little bit of a pullback or correction to add to the positions that we have. We note there are still more and more signs of foreign money coming into this market. When we look at the EEM, it's still trading relatively weak. You're also seeing a situation we wrote about in the midweek report with the Dow Industrials starting to even trade a little bit better than the S&P. The reason for that, and again, I can't emphasize this enough if you're looking to trade stocks, money comes in from foreign countries in big household names like IBM and DuPont, which we have in our sector report, and other big names, even Procter & Gamble's. We've got staples in there as well, and so far the staples actually haven't been doing as well. It's a little bit more defensive, the sector, but they did hit new highs for the move recently, and my guess is you're going to see the staples actually continue to do well and even do a little bit better as time goes by. We're going to talk about sectors on the next call because we are doing the sector review this weekend. In terms of the TLT and Treasury bonds, obviously the bonds are lower than we thought they would be. We were stopped out of our short-term trade. The very favorable accumulation models on bonds have gone to neutral. We do believe that this is a long-term bear market in bonds, but what that means is when we do get a rally in this bond market, it's going to be very sharp and very violent. The neutral, accumulation models suggest that we are going to get that rally. So if you're a bond buyer, I would be looking to accumulate bonds here in this general area slowly, with the idea being that we will be able to see the TLT at 94 to 96 later in the year. We can either sell or enjoy a little bit of paper gains there. In terms of the commodities, we've been watching very carefully. The market really doesn't seem to care about this Egypt business. Frankly, I'm not sure that's correct. I'm much more concerned about that than the market seems to be. But guess what? The market is always right, so I guess for now I'm not. So I'm just a little bit cautious here. However, let's talk about the commodities in the absence of this type of maneuver. We have some seasonal tendencies for the commodity markets to fall into May, and you're seeing gold, for example, sort of chop around. And I think that gold is actually going to get going again in May. What that means is gold is probably going to trade between 128 and 135 on the GLD, with a possible move down to 126 somewhere in there. So I would be sort of adding to gold positions below 130 on GLD with the idea that this market's going to show some get up and go again in May. The same with oil. Oil has a tendency to fall into May, and it's choppy. I think we're going to get a chance somewhere in the next couple of months to get the USO below 36. I would be accumulating it in here. I'd be looking to get it below 36 somewhere as well, with the idea that maybe we end up with an average price of around 36.10 by May, and then I think you'll get a nice summer rally in the petroleum complex. Looking at DVC, which is the main commodity ETF that we follow as a representative of the CRB, a lot of support at 25, 26. A pullback to 26 from here would be about 10% and would be pretty attractive, and that could very well happen. Looking at some of the agricultural commodities, they have a tendency to pull back from here into summer. I'm looking at the JJG, which has made new highs recently, but still seems to me to be in a position to pull back, and if it does, we're going to look at that for summer. Again, I don't mind having a position in JJG right now, but I would not be overweight in that area. We've had a couple of quick stock questions. We'll do them right away.